Promise, here's Tata Motors CFO P.B. Balaji talking to Autocar India's editor Horma Sarabji, sharing the company's growth roadmap for JLR and its turnaround plan in China and other markets as well. P.B. Balaji remains confident that the company's working capital will improve with the new strategies planned.
What we see today is a full-fledged turnaround plan, and typically turnaround plans runs into three distinct buckets. There's one work around what we call a sales enhancement, which is about stepping up your portfolio, stepping up your products, stepping up your customer engagement, stepping up your sales activations. That piece of work got done. Second piece of work that was done on all things costs and cash, where I think significant amount of effort has gone through in terms of taking costs out of the business and ensuring that we are benchmarking with others, ensuring that we are driving design costs down, designing out needless complexity, and also ensuring that we are adding complexity which is value adding at various points in time to also ensure that we are able to deliver better sales. And the last piece of work is which was all things capabilities, which is some of the more fundamental issues in the business we had to go and fix. And for Tata Motors, one of the big areas that we have focused upon is getting the reliability of our supply chain up across the board. And that was the first turnaround 1.0 last year, which after a lot of time, we actually managed to get, almost after 5 years, we generated positive free cash flows last year, coming in after almost 5 years, which is quite a good achievement in that set of circumstances. And therefore, we now called out turnaround 2.0, where the specific focus was on passenger vehicles. And the first milestone was to hit an EBITDA break-even, which I'm happy that we did it last year. We need to ensure that we stabilize that, we are able to get sustainable EBITDA break-evens, and then move it from there into an EBIT break-even, then to a PBT break-even, and then all the way to a cash break-even. And it is very much doable.
The business still seems very subscale. Is this a big challenge? Because, further investments are driven to some extent by the volume and amortization thereof. So is scale an issue for you in this market?
See, I think volume is important, but volume is not everything. We need to be a bit careful on this one, because the auto industry has this myth of saying that everything is volume, volume, volume. I'll just nuance it by saying that it is not volume. It's actually looking at value. You're looking at revenue as a larger measure.
Right now we are in a state of flux. The industry is in a state of flux. IC engines, EVs, autonomous, connectivity. Is this a challenge? Where do you deploy your resources? Because at one point you have your bread and butter IC engines, and the future says electric. So from a strategy standpoint, how do you kind of grapple with let's say, these multiple fronts where investment and technology is needed?
Where we need to be careful to get the maximum value out of it is that I'm thinking long term. What the platform architecture gives us, both Alpha and Omega architecture gives us, is to start thinking about the next 4 or 5 years of cars coming in. So which means if I'm negotiating with a vendor on particular product, I'm not negotiating only for that part. I'm looking for the next 5 cars that are coming through on the platform itself. That gives me scale. The fact that we have a capital constrained environment helps you to think more clearly on what is the capital you want to be in, what is the capital you don't want to be in. But at the same time, there will always be opportunities. Take electric, one of the biggest collaboration that is now currently happening between JLR and Tata Motors. Because with I-PACE launch, they've actually proven to the world that they can do stuff in style.
And in terms of an EV strategy, obviously I think an EV would be a separate platform. So is there a lot of investment going into, let's say, newer technologies, especially on electrification?
These platforms come package protected for electric as well. So therefore, there's not like we're going to have a separate platform that we'll end up creating for EVs. And therefore, these two platforms take care of all the requirements in the foreseeable future.
Right. And I just want to touch a little bit on JLR. Obviously, it's facing strong headwinds right now, facing difficult times. Yeah. Just want to understand, what's the game plan over there?
Yeah, let me split the whole JLR approach that we're having into 4 buckets. That is product, geography, cost, cash, balance sheet. Because typically, if I address these 4 things, the JLR question invariably gets answered. As far as product is concerned, they have a pretty rich product pipeline coming through, because we have Evoque coming in, the new Evoque launches just now. Then you have the Defender coming in subsequently. We have the full year of E-PACE coming in. We have the full year of the 18 model year and the PHEVs of the Range Rover Sport coming in there. And therefore, the product pipeline is absolutely full. And we will then, over the next 3-4 years, we move to 16 nameplates from the current 12. And we then by 2020, we have all the products available on some electric option or the other. When I move to geography, this year we'll probably meet, barring China, every other market will meet our numbers in terms of our total growth. This is despite diesel, this is despite diesel taxes, this is despite Brexit, this is despite tariffs, everything. China is where we have an issue, and China is basically where we are resetting our priorities as to how we go to market. From a push strategy of pushing volumes in, starting the beginning of somewhere around mid of this year, we have flipped it and say we would love to do a pull kind of a strategy where we are a premium OEM. It's only fair that we focus on branding, we are focusing on profitability of your dealers, and we are focusing on exclusivity. And you do that, then automatically volumes start coming in. We are confident that with this, China should start delivering for us. And this is and that's the reason we have taken the hit on our chin in terms of the volumes. We have taken the hit on the chin in terms of what we saw as growth rates in that market. But that's absolutely what the doctor ordered as far as China is concerned. And this is now fully aligned with within the entire business from Ralph all the way down to us. But this is not going to, the market is going to get even more tougher, simply because there's Brexit that we need to deal with. There are still more clouds in the horizon. US has had a peach of a ride. No one knows whether US will get more sanguine, and inverted yield curve is not something that anybody would like. In that situation, we need to be clear that come what may, demand is likely to be challenged. We have our plan of action ready. We need a plan B as well, which is the reason why Project Charge got launched. And when Project Charge got launched, one of the key focus areas is cost and cash. And that is every line of the P&L is being looked at, identical to what the turnaround plan in Tata Motors is about. We have delivered in CV, we have delivered in PB, we'll deliver in JLR as well. There's no debate about it. Project Accelerate, which has been launched, is all about fixing their capability issues. So if you notice, the theme is almost similar: sales activation, cost outs, and capability builds. And capability builds for them is on three fronts: timing of launches, quality of launches, cost of launches. If you get these three right, JLR is fundamentally fixed for the pieces related to their capabilities. So I think we have a pretty clear plan of action on costs, and we have put out over the next 18 months, we want to take out 2.5 billion out of that place. 1 billion coming out of capex. So this year we will deliver the 4 billion. Next year also we'll deliver 4 billion of capex. From the 4.5, we'll reduce that to 4. Committed will happen. We will improve working capital by at least 500 million. That's a bare minimum number. That alone is 1.5 billion. And then this year and the next 18 months, 1 billion of cost will come out of that place, be it on material, be it on VME, FME, other indirects, the whole works. So identical to what is happening in Tata Motors. With this in place, if 2.5 billion cost comes out, you then have your threshold EBITDA margins, which are now sitting at about 10% moving to about 14%. And then we are committing that going forward will be 11 to 12% is what our capex is, which means fundamentally I've become a cash accretive business thereafter. When I become a cash accretive business, you don't have an issue of balance sheet. You don't have an issue on borrowing in that place, and they go back to their heydays. So you'll notice that we are not touching a single product that we would want to launch. Is everything there. By this, when you have this 4 billion of capex, you'll have all the MLA mid, MLA low, MLA high architecture products going in. We will have every one of the products on the 16 nameplates we want. We would have completed ADAS, we would have completed electric. So I think we have a comprehensive plan of action in JLR ready, and those executions are happening methodically. Take even yesterday's sales, you'll notice that the reorientation of US more towards Land Rover coming out of Jaguar is happening as well. So I'm getting more and more confident that our strategy is working on the ground with respect to JLR.